All right, hello everyone. Hope everyone's having a good Sunday night. Now, what I'm going to do is teach you pretty much everything you need to know about technical analysis and what goes on in the hedge fund world on a Monday morning. As the trader of various hedge funds or the head of trading, I know this firsthand. I'm not just making it up or regurgitating from what I heard, or regurgitating what I've heard from someone else. But anyway, blah blah blah. Let's get right into it. Now, the trader's job in the institutional investment world is to know what's going on in the markets, to have your finger on the pulse of the markets. In addition to traders, there's portfolio managers, there's analysts. They do something different. The portfolio manager decides what's going to be in the portfolio, what's not going to be in the portfolio. The analysts help the portfolio managers. They're kind of their like staff. But the traders are the people that know what's going on in the market. Now, the most important benchmark or thing that we look at is the S&P 500. And what I have here is the S&P 500 ETF, the SPY. Now, going into the week, I got a lot of trades to do. I want to know where the important price levels are. That's what trading is. It's knowing where the important price levels are. I mean, of course, it's a little bit more than that. But as we can see here, you don't need to be a market guru to see that this 416 level was important for SPY. It was resistance here, it was resistance here, it was resistance here. When a market's moving higher, there's not enough supply to fill all the demand. When we get to a resistance level, there is. A resistance level is a large group of investors who are trying to sell at or close to the same price. So when the market's moving higher, there's not enough supply, but when we get to resistance, all of a sudden this changes. Now, a lot of times when we get to resistance, we tend to have these rapid sell offs. Why does that happen? Well, because if you're an investor and you're thinking about selling and you're watching something go higher, and all of a sudden you notice it's not going higher anymore, you can make the logical deduction or assumption that, oh, gee, there must be other sellers entering the market. All of a sudden now there's more supply than demand. There's more sellers than there are buyers, or I should say there's more shares for sale than there are shares to be bought. So some of these investors who want to sell start to get a little worried that they're not going to be able to sell their shares because if someone's willing to sell at a lower price, that's who the buyer is going to go to. They're going to go to whoever's willing to sell at the lowest price in town. If you want to sell at 416, but there's someone who's willing to sell at 415, well, that's who they're going to go to. So the sellers or the investors who created the resistance start to get worried and they start to undercut each other, and it makes this snowball effect. Now, the opposite is true with support. When we're going lower, there's not enough demand to absorb all of the supply, so the sellers are forced to offer their shares out at a discount, and this forces a downtrend. Now, when we get to a support level, the tide turns. There's enough investors who are willing to pay that price that they can take in all of the shares. A lot of times when we get to support, we get a bounce. Why is this? The buyers are afraid that the sellers are going to go to someone else. The sellers are going to go to who's ever willing to pay the higher price. It's the exact opposite as when we get to resistance. So the buyers start to jump in ahead of each other and outbid each other, and we get a snowball effect. 99% of the time, what they're saying on CNBC or Fox Business News or Bloomberg is absolutely wrong. I tell my students, don't even watch that garbage. Just turn it off. They're just going to confuse you. It's all about supply and demand, right? It's all about human psychology. Something bouncing off of a support level is psychology. It's anxious buyers outbidding each other. Something selling off of resistance is psychology. It's anxious sellers undercutting each other. Now, what else do we see here? Oh, support turned into resistance. Resistance turned into support. How does this happen? Once again, it's psychology. There are investors who bought here who regret doing so when the price goes lower. We see this rebound, and a lot of these remorseful buyers are like, all right, if I can get out of this at break even, I'm going to. I made a mistake. I shouldn't have bought it. I'm going to get out at break even if I can. So we have these remorseful buyers placing sellers at the level that was support. If there's enough, support can turn into resistance. What do we have next? Resistance becomes support. How does this happen? It's seller's remorse. It's the exact opposite. People sell, the price goes lower, A lot of these sellers regret their decision to sell, and they tell themselves, if I can buy my shares back at break even or at the same price I sold them at, I'm going to. So if you have enough remorseful sellers placing buy orders at the level that they sold at, well, the level that was resistance can turn into support. So when you look at a chart, you're not looking at these like mysterious astrological patterns, at least if you're doing it the right way. You have to look at this through the prism of what does this tell us about psychology and supply and demand. All right, now you might be saying, well, gee, Mark, why would a level that was resistance become a resistance again? Psychology, buyer's remorse. There's people who bought here who regret doing so when the price goes lower, and they tell themselves that they're going to get out if they can at the same price. So you have support becoming resistance because of buyer's remorse, but you can also have a resistance level staying intact because of buyer's remorse. Here we have the opposite. Why would support become support again? Well, we have a lot of short sellers who sold, the price goes against them. They tell themselves, if I can get out at break even, I'm going to. So if there's enough of these remorseful short sellers placing their buy orders at the level they shorted at, the level can remain support. Trading is understanding where these important levels are. Why is it important at 416 and not 405 and not 414 and 407? I mean, I don't know, and I don't need to know. You just need to know where these important levels are. In the institutional trading world, this is what we look at. We don't care about things like Elliott wave or Gann theory or Fibonacci, all right? We worry about supply and demand and psychology. And if you look at a chart right, that's what it is showing you. Now, the S&P is made up of 11 sectors, and sometimes different things are in the driver's seat at different times. Technology sector, I think right now is kind of in the driver's seat. Notice how it's testing this resistance. Now, this concept, or not even a concept, but this dynamic of levels that were resistance becoming resistance, levels that were resistance becoming support, it is something people take for granted. Like in business school and academia, they teach you that there's this random walk, you can't outtime the market. Well, guess what? They're wrong. I've known a lot of people that have made a lot of money by outtiming the market, and the way they can do it is looking at the right things to look at. Resistance way back in August became resistance here, and it's been resistance over the last week. How is it that this sector that's worth billions or trillions of dollars could have the exact same valuation now that it did back then? Psychology. There's not an academic professor in the world who doesn't understand trading who can explain this to you. Resistance can remain resistance because of buyer's remorse. Resistance can become support because of seller's remorse. We see that on a lot of charts. Resistance becomes support. Resistance becomes support. People sold, the price goes higher. They tell themselves, I made a mistake. I want to buy my shares back. I'm only going to do so if I get them for the same price I sold them at. Remorseful sellers placing buy orders at a level that was resistance can turn resistance into support. You can see it on pretty much any chart. Don't listen. Well, I already told you this, but don't listen to what they're saying on the media. They're always going to try to be like, oh, the market was up today on Biden this or Powell that or Yellen this. 99% of the time, they're wrong. The market's just moving based on investor psychology. So this is our biggest sector. I think this is probably the most important thing to watch here. If we get through, we can make a move higher, but if we don't, all of a sudden those anxious sellers are going to come in and start undercutting each other, and we're going to have a move lower, right? You don't need to be a market guru to see resistance, 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 resistance becomes support, resistance becomes support, resistance becomes support, and so on and so on. Remember, there's 11 sectors. Tech is the biggest. Healthcare is the second biggest. Resistance stayed resistance. Support stayed support. This chart teaches a lot of lessons. And the resistance became support. I'm sorry, support became resistance. We kind of toyed with this level, and now we're kind of trending lower here. Now, if you understand this concept of how resistance can become support and support can become resistance because of buyer's remorse and seller's remorse, you are going to be so far ahead of other people who don't know what the heck they're doing. I mean, listen, I'm no great genius, but I did this for 25 years. So I picked up a couple things. Now, why would something make a really fast move lower and then a really fast move higher like this? We see this on a lot of charts. Fast move down, fast move up. Well, what's one of the reasons for resistance? Remorseful buyers trying to get out at break even. When we fall really rapidly through a level like this or through levels, there's just not a lot of time for there to be a lot of buyers having a vested interest around the same price. So we fall lower when investors decide, oh, gee, that news, whatever drove it down, isn't as bad as we thought. They come in and they go to buy, and there's just not a lot of sellers around. You don't have those remorseful buyers trying to play sellers or trying to get out at break even. So a lot of times we get a fast move down, we get a fast move up. When we're at a levels where there's been a lot of trading, well, you have the same dynamics, but there's a lot more vested interest. So there's going to be a lot more remorseful buyers placing sell orders, a lot more remorseful sellers placing buy orders, and the stock or the security is going to take longer to get through those levels. Here we have the fast move up, fast move down. Well, when we blast through these levels really quickly, we just don't have a lot of time for remorseful or for people to sell who are going to be remorseful and trying to buy their shares on the way back down. Fast move up, fast move down. All else being equal, you're thinking about buying something and it makes a slow move down to support and it holds the support and goes up, great. But if it makes a really fast move down to support, there's a good chance it's going to make a fast move back up if that support holds. Here's our financials. Here we can see a really perfect example. Support becomes resistance. Resistance becomes support. Support becomes resistance. We got our fast move down, fast move up. Now, there's been a lot of talk about the banks, and there should be, and this is probably the second most important thing to watch. I've been doing this for a long time, and I don't care what Janet Yellen says or what Powell says or what Biden says. They're all talking about how the banking sector is safe. All right, well, whatever. That's not what the stocks are telling us. Politicians lie, politicians are wrong, analysts lie, analysts are wrong. The market is never wrong. Does this look to you like the action of a sector that's been saved? Now, this is the industry. This financials are the sector. Within the sector, there are industries. This ETF follows the banks. Does this look to you like a sector that's been saved, or I'm sorry, an industry that's been saved? Not to me. And look what we see here. This is an example of market memory. Remember, resistance can become support. This was resistance way back in 2020. When we had this big sell-off, where did we find support over the last month? Well, the level that was important. Some price levels are more important than others. Sometimes we know why, sometimes we don't. But it just is, okay? Resistance here became support 3 years later. This is what we call market memory, and this is trending lower. It seems to me as though the sellers are in control of this market. This does not look to me like an industry that's being saved. This is our our consumer discretionary sector. Once again, we could see support became resistance, but we've just been kind of consolidating. This is a neutral sector, so we don't need to spend too much time on this. Industrials, okay? Clear resistance around 103.50, clear support. Remember, resistance is a large concentration of sellers. When the stock gets or the ETF gets to resistance and it stops going higher, some of these sellers start to get anxious and they start to undercut each other. And it causes a snowball effect. It's not because of what they're saying on CNBC. When we get to support, investors who want to buy start to notice that, oh, gee, there must be other buyers around. That's why the price is not going any lower. They get worried they're going to miss out, so they start outbidding each other. You get the snowball effect on the way up. This is an interesting pattern. I don't really pay attention to a lot of patterns because I think a lot of them are just kind of dumb. But descending triangles and ascending triangles make a lot of sense. This is a descending triangle. Notice how it looks like a triangle, okay? Now, what's going on here? Well, the buyers are kind of just chill. They're at 97. They're like, all right, well, if it gets to my price, I'll buy it. If not, I don't really care. I'm just going to wait. The sellers come to me. They do. If not, whatever. I'll miss it. Big deal. Now, these descending triangle line, notice these lower highs. Markets travel in peaks and valleys. They don't go in straight lines. So when we have peaks forming at lower levels than the prior peak, we call these lower highs. This tells us something. It's not just symbolic. It tells us that as time is passing, the sellers are becoming more aggressive. As time is passing, the buyers are willing to be chill. If you have aggressive sellers and can place in buyers, regardless of what market it is, stocks, real estate, commodities, it sets the stage for a move lower. So to me, in my opinion, I think there's a good chance that this support breaks, meaning the sellers overcome the buyers, or the sellers outpower the buyers, and we start to move lower. When a support level breaks, meaning the price goes below it, again, it's not just symbolic. It tells us that the investors who created the support with their buy orders have left the market. They either finished their orders or they canceled their orders. Regardless, when you take demand out of a market, it sets the stage for a move lower. Unfortunately, technical analysis has a bad rap, but it deserves it because a lot of technical analysts don't know what they're doing. They might have read some books, they might have traded their personal account. I was the head of trading at three different big institutions. I traded for Mary Gabelli and Steve Cohen, two of the greatest traders in history. Well, Gabelli's more of a money manager, one of the greatest money managers in history. Cohen's probably the greatest trader in history. But again, you don't need to be a market guru to see that some price levels are more important than others. If you know where these price levels are, it's going to help you because guess what? You are going to know where you should put in your sell orders or your buy orders. Just say in theory you bought XLC, like right down here, and you tell yourself, oh, I'm going to sell it if it gets to 65. All right, well, you're just guessing. You got to let the market tell you what to do. The market should tell you where to put your order, not just guessing. It'd be great to sell it at 65, but because 60 was resistance, there's a good chance there would be resistance there again. We got those remorseful buyers trying to get out. So instead of saying I'm going to sell it at 65, you say I'm going to sell it around 60. And not as good as selling it at 65, but it's better than missing it. Here we have support become resistance, buyer's remorse. People bought, price goes lower, they want out at break even. They place their sell orders at the same level they bought. Buyer's remorse turns support into resistance. Here we have people that sold, price goes higher, they regret selling. They tell themselves, I want to buy my stock back, only if I get it at the same price I sold it at. Seller's remorse turns resistance into support. And we got to that support. The buyers get anxious, they're going to miss out, they outbid each other, snowball effect. Get to resistance, the sellers get anxious, they're going to miss out, they undercut each other, snowball effect. It just doesn't need to be as complicated as most people make it. Here we got resistance, resistance, resistance. All right, we've discussed the reason why. It's that buyer's remorse. You don't need to be a guru here. This is our energy sector. Resistance becomes support, resistance, support, resistance. In the institutional trading world, this is what people look at. Here we have our fast move down, fast move up. Well, we moved down so fast and we gapped through these levels. A gap means there was no trading at these price levels. If there's no trading, no one could have bought there because it didn't trade there. So on the way back up, when investors think this move lower was overdone or an exaggeration, there's just not a lot of sellers to buy from. So they're forced to pay much higher prices. Fast move down, fast move up. Certain levels are more important than others. Resistance, resistance, support becomes resistance, resistance becomes support, support becomes resistance. If you know where these levels are, it will make your life so much easier and you'll probably become a profitable trader. This is just an example of a reversal day. Sometimes trends change in one day. We got this big move down and we go all the way down to here. So if you were to look at this in the morning, you would think the red team or the sellers are still in control. But by the end of the day, the buyers overpowered them and they came all the way back. So this trend changed in a day. This is oil. Here's resistance. Why is there resistance here? Former support level. Support can become resistance because of da 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 da, buyer's remorse. Utility sector, even in boring sectors, we see these same principles. Support becomes resistance. This is months later, 6 months ago. Support, now it's resistance. Resistance became support. Now, if something's going lower and you're thinking like, oh, gee, I'd like to buy XYZ, but I don't know where to buy it, well, look into the past. If it was getting close to a support level or a level that was resistance, there's a good chance there's going to be support there, and that might be where the trend changes, the trend has turned. So that would be a good place to have your buy order. If you're thinking like, oh, gee, I want to buy XLU if it gets to say 65, well, maybe it gets to 65, right? Maybe it doesn't, but there's a good chance it gets to 67.25 and rallies. So instead of just guessing to buy it at 65, let the market tell you what to do and let the market determine where you're going to put your order. Remember, the market is never wrong. And here we see that descending triangle pattern again. The lower highs tell us the sellers are in control or getting more aggressive. We break the support. The best traders don't have secret systems. The best traders have agnostic attitudes and they let the market tell them what to do. Resistance became resistance, support becomes resistance. Knowing where these important levels are is one of the keys to being a successful trader. It's like having a roadmap to the market. In my opinion, if you don't know where these important price levels are, I don't see how you could be a good trader. It's like, being a golfer who can hit the ball great at the range, but you can't putt. All right, you're never going to get a good score if you can't putt. Here we have our fast move down, fast move up. And this is our last sector of the, remember, there's 11 sectors in the S&P. Different ones are in control in different times. And we see here resistance became support, support becomes resistance, resistance becomes support, support becomes resistance, and now we're just consolidating or trading sideways. We're in equilibrium now. The supply and the demand are kind of equal. So things are in equilibrium. They don't really move. Things are out of equilibrium. If there's more supply than there is demand or vice versa, that's where things move and that's where we can make our money. All right, everyone, I hope this helps out. Please check in during the week. Please subscribe to our site here, our YouTube page at Stock Market Jobber. And I will see you soon. And there should be some interesting things going on with this week, so make sure you check back. We got the debt ceiling. We got what I think is the banking crisis is just kind of almost starting to get going. I think we're in the, as Churchill said, maybe not we're at the end, but we're at the end of the beginning. So I think it's just getting started, and we had our first couple rounds, and I think we're going to move lower. I mean, just take a look at PacWest Bank. That bank was supposed to be safe, and now that's collapsing, or at least the stock is collapsing, just like we saw with First Republic and Silicon Valley. All right, everybody, that's it. Hope you have a good night, and I will see you this week.